Right now, in pre-market trading, Lumen Technologies, ticker LUMN, is trading at $7.90 per share. That's a gain of another 11 cents or 1.41%. This move, this follow-through, is happening on the heels of an absolute explosion in yesterday's session, where the stock rocketed up 75 cents, a staggering 10.65% gain to close at $7.79. This is not normal behavior for a stock like Lumen. And the immediate insight, the reason for this violent repricing, is what changes the entire conversation around this company. Yesterday, Lumen announced a multi-year, multi-million-dollar strategic partnership with Palantir Technologies. This isn't just a simple supplier agreement. They are jointly pursuing solutions that pair Palantir's artificial intelligence platform, their Foundry operating system, with Lumen's high-speed connectivity fabric. The market is reacting not just to the headline, but to the implications. As Lumen's CEO Kate Johnson put it, Palantir frees data while Lumen moves it. This is the kind of narrative shift that can take a stock from the brink of delisting to a must-watch turnaround story. For years, the common belief, the widely accepted market expectation, has been that Lumen Technologies is a dying dinosaur. Most people still think of it as CenturyLink, the old-world telecom provider saddled with a mountain of crushing debt, a shrinking consumer base still stuck on copper wire DSL, and a dividend that was, quite painfully, eliminated. For the average person doing some self-investing, maybe looking for investment help or opening an individual brokerage account, Lumen was the definition of a value trap. It looked cheap, but it was cheap for a reason. You'd check it on your Robinhood app or SoFi Invest platform and see nothing but downward momentum, a stock that seemed to be in a permanent state of decay. The expectation was that this company was simply managing its own decline, destined to be picked apart for its assets in bankruptcy. This has been the story for years. But the reality, the deeper truth that this Palantir news is dragging into the light is that Lumen might be one of the most misunderstood infrastructure plays on the entire market. The company has been executing a painful, years-long pivot away from that dying consumer business and repositioning itself as the essential picks and shovels provider for the AI and cloud industries. The reality is that all the processing power of an NVIDIA stock or the cloud services from an Apple stock are useless if the data can't move from data center to data center with extremely high speed and low latency. And that's what Lumen's core asset is, one of the largest fiber optic networks on the planet. The partnership with Palantir is the market's first tangible, high-profile validation of this new business model. The market expected bankruptcy. The reality, as of yesterday, is that Lumen is now a strategic partner for one of the most prominent names in AI and defense. Let's look at the recent trading action because it tells the story. This isn't a one-day event. While yesterday's 10.65% pop was the headliner, the stock has actually surged over 34% in the last month alone. This is a stock that scraped a 52-week low of $3.01 and is now making a serious run, fueled by enormous trading volume that is far surpassing its 15.87 million share average. This momentum began building well before the Palantir news, suggesting that larger institutional buyers using sophisticated platforms, perhaps through Fidelity Wealth Management or Interactive Brokers, were already sniffing out this change. They were seeing the internal shifts that retail investors, busy trading Robinhood fractional shares of Tesla stock, were missing. What were they seeing? First, the debt. The single biggest risk for this company was its $33 billion in total liabilities and the impending debt wall. But in March of this year, Lumen successfully completed a massive debt restructuring. They pushed a $9.5 billion wall of debt that was due in 2027 out to later dates. This wasn't a final solution, but it was a critical injection of time. It gave the company the financial flexibility and breathing room to actually fund its transformation. Without that restructuring, this Palantir deal would be irrelevant. Second, the earnings, while still messy, show the pivot in black and white. In the second quarter report from July, the headline numbers looked familiar. Revenue missed slightly at $3.09 billion, and it was down 5.4% year over year. This confirms the expectation. The old company is still shrinking. But inside those numbers was the reality. The Grow segment, which is their enterprise-focused fiber and network as a service business, is where the new company is being built. Fiber broadband subscribers grew 17% year over year to 1.12 million. That segment now accounts for 45% of their total broadband revenue, up from 35% just a year prior. Meanwhile, the legacy copper wire subscribers fell to 1.39 million. This is a deliberate milking of the old copper assets to fund the high-speed fiber build-out. Even more importantly, management raised its full-year 2025 free cash flow guidance by a massive $500 million, projecting $1.2 to $1.4 billion. That's the signal. That's what the smart online investing crowd saw. They are managing the decline of one business to fund the birth of another, and they are becoming cash flow positive in the process. So, what does Lumen actually do? It's not CenturyLink anymore, not really. The company has two distinct businesses operating under one roof. The first is the legacy business, providing phone service and slower copper-based internet to consumers and small businesses. This segment is being intentionally deprioritized and in a managed decline. The second and far more important business is the Grow segment. This involves selling high-capacity, high-speed fiber optic connectivity to large enterprises, government agencies, and, most crucially, to cloud providers and AI companies. They are aggressively expanding their fiber network, with a stated goal of reaching 47 million fiber miles by 2028. This isn't about selling SoFi ETFs or managing Fidelity IRAs. This is about owning the physical roads that all modern data travels on. Their connectivity fabric is designed to let companies instantly connect their private data centers to public clouds like Google, Amazon, and Microsoft, and now to AI platforms like Palantir's. This is a high-stakes, capital-intensive bet that owning the network infrastructure is the most valuable position to be in. This brings us to the future outlook, and the tension is clearer than ever. The primary catalyst is exactly what we saw yesterday. The Palantir partnership is a template. Lumen has already announced similar partnerships with Google Cloud and data center operator Digital Realty. The bull case is that this is just the beginning. As AI models become more complex, the demand for high bandwidth, secure, and reliable connectivity will explode. Lumen, with its massive pre-existing fiber footprint, is perfectly positioned to capture this demand. The market is slowly realizing that LUMN isn't a competitor to T-Mobile or Verizon, it's an infrastructure supplier to them, and to every other major tech company. Many online investing sites and Fidelity mutual funds are still categorizing this as a telecom, but it's beginning to look more like a data infrastructure company. Before you make any investment, you have to decide what this company is. Is it the old dying phone company, or is it the new essential AI infrastructure provider? Now the risks are just as massive. That $33 billion in debt didn't disappear. The restructuring just bought time. Lumen is in a race. Its grow segment revenue must accelerate faster than its legacy revenue declines. If it can't, that debt load will eventually become unsustainable, and the company will face the very bankruptcy that bears have been predicting for years. The company's total equity is still negative at minus $595 million. Its net income last quarter was a staggering loss of $915 million. The financials are, to be blunt, terrifying. This is not a stock for a cautious intelligent portfolio or a Schwab Intelligent Portfolios account. This is a high-risk, speculative turnaround play. The analyst community remains deeply skeptical. The consensus price target is around $5.41, which is significantly below where the stock is trading right now after this rally. Over half of all analysts covering the stock have a sell rating. This is a classic Wall Street disconnect. The market is rallying hard against the consensus. This is a perfect opportunity to ask for your take. Comment below if you think this Palantir partnership is the real deal for Lumen, or if you think this is just a temporary headline-driven spike.